Welcome back to the deep dive. Today we're jumping into something that affects literally everyone, but often feels kind of opaque, doesn't it? How governments manage your money.
That's right. We're talking about governmental accounting.
Exactly. It's this whole unique, sometimes really complex world, and it's way more than just numbers on a page, right? It's about public service, transparency, and this huge idea of accountability.
Absolutely. Accountability is key. And our source material for this deep dive, it's fantastic, really gives a comprehensive look at the concepts, the standards, the real-world applications. It sets the stage perfectly for understanding this whole financial ecosystem.
So our mission today is to kind of pull back the curtain on what makes governmental accounting tick, why it's so fundamentally different from, say, how a business tracks its profits.
And crucially, what all of that means for you, the listener, as a citizen.
Okay, let's get into it. My first big question, and I bet a lot of listeners have this one too, why does governmental accounting even need its own special set of rules? Why can't, I don't know, the city government or a state agency just use the same accounting principles as a tech company or my local coffee shop? Isn't money just money?
That's the perfect place to start because it gets right to the absolute core difference.
Yeah.
Think about those commercial businesses, the tech startup, the coffee shop, any private company.
Okay.
Their main goal, their reason for being, is almost always about generating net income, making a profit, increasing wealth for the shareholders or owners.
Right, the bottom line, growth, returns, making the stock look good.
Exactly. Their financial reports are all geared towards showing profitability, how efficiently they're making money, their overall financial health from an investor's point of view. It's about showing that return on investment.
Okay, makes sense.
But governments, they operate with a completely different objective,
Yeah.
fundamentally different. They are not trying to make a profit.
Right, no profit motive.
Their focus is squarely on providing services efficiently and effectively to the public, using public money, and doing all that while strictly following a whole host of laws and regulations.
So it's less about making money and more about delivering services responsibly.
Precisely. Public service and demonstrating responsible stewardship of the funds they've been entrusted with by you, the citizens. It's about delivering public goods transparently and legally.
Stewardship. That sounds like a key word here. It's about being good caretakers of the public's money, making sure it's used for what it's supposed to be used for.
Mhm.
Can you unpack stewardship a bit more in this context?
Yeah, absolutely. Stewardship in governmental accounting is all about demonstrating to the public, to the citizens, that the government has managed its resources responsibly. That means efficiently, effectively, ethically.
Okay.
It's about being transparent and fully accountable for how every single dollar, whether it came from taxes, fees, grants, whatever, is actually spent. Think of it like a really serious fiduciary duty.
Like a legal and ethical obligation.
Exactly. An obligation to act in the best interest of the citizens who provide those resources. So this means clearly showing, look, these funds went to the specific programs they were designated for.
Like road repairs didn't suddenly pay for office furniture.
Right. And it means showing that spending didn't go over the budgeted limits. And really critically, that all the financial activities followed the sometimes very complex legal and legislative rules put in place.
So it's foundational, really, because public trust depends on it.
Completely. Without this kind of demonstrated accountability, how would citizens know if their money is being used wisely, or ethically, or even legally? It's the mechanism for proving they deserve that public trust.
That makes total sense. It's like the government showing its work, proving it upheld its end of the bargain. And our source mentions something called fund accounting as being key to this accountability. Is that the sort of magic behind how they keep track?
Fund accounting is definitely a core concept. You could almost think of it as the specialized operating system for governmental financial reporting. And its objectives directly support that big idea of accountability and stewardship we just talked about.
Okay.
At its heart, fund accounting lets these service and mission-driven organizations, which governments obviously are, meticulously track and report on compliance. Compliance with two key things.
What are those?
First, compliance with very specific spending purposes. These are called fund restrictions.
Ah, like money earmarked just for schools or just for parks?
Exactly. Money allocated for Project A can't just be shifted over to Project B without going through the proper channels. Second, it lets them track compliance with spending limits. That's the budget.
So if the city council says, okay, $10 million for park maintenance this year, fund accounting is the tool that makes sure they don't accidentally or otherwise spend $11 million or spend it on something totally different, like, I don't know, a new fleet of cars.
Precisely. And your analogy of earmarking money or putting it into separate, clearly labeled buckets, is perfect. That's exactly what it does.
Okay, buckets. I like that.
It's all about segregating resources, keeping money for specific purposes totally distinct from other money. Governments use these funds for their internal accounting, managing resources for specific programs or departments in great detail.
Right.
But crucially, they also use it for their external reporting to demonstrate this fiscal accountability. It's the mechanism to clearly segment money. So funds for, say, building a new library are kept totally separate from funds used for daily operations, like police salaries.
Each bucket has its own rules, its own purpose.
And even more than that, each fund is treated almost like its own mini entity within the government. Each fund has its own financial records, its own rules, its own accountability measures. And here's a key technical point. Each fund constitutes an independent fiscal and accounting entity.
Independent.
Yes, and it's a self-balancing set of accounts.
Self-balancing, what does that mean exactly?
It means that within each individual fund, each bucket, all the debits, must equal all the credits. Just like in regular double-entry bookkeeping, but applied to each separate fund. Money can't just vanish or be shuffled around between funds without a trace.
Yep.
It enforces control and transparency at a very basic structural level.
Wow, okay. That self-balancing part really drives home the idea of separation and control. Like each bucket has its own ledger that has to balance perfectly, prevents things getting mixed up. Okay, so we get why it exists, accountability, public service, stewardship. But who actually uses these specific governmental accounting rules? Is it only governments? Or does it extend further?
You'd think it might be that simple, wouldn't you? Just governments. But this is where it gets really interesting. And honestly, it often surprises people.
Oh, how so?
It's not solely determined by the industry, like healthcare or education. Instead, whether these governmental accounting principles apply comes down to two really crucial factors. The entity's basis of organization, its legal structure, and its primary funding sources.
Wait, basis of organization and funding sources, not just what they do. That feels counterintuitive. Can you give an example to make that clearer?
Absolutely. The hospital example is perfect for illustrating this. It really shows the complexity. Imagine a hospital, right, providing essential medical care.
Okay, got it. A hospital.
Now, that single hospital could actually be structured in one of several ways, and each structure dictates a different set of accounting rules.
Different rules for the same service. Okay, I'm listening.
One, it could be governmentally funded. Maybe it's run by the city or the county or the state. It gets public funds. In this case, it would likely operate as something called an enterprise fund within the government.
An enterprise fund.
Yeah, that's a type of fund governments use for activities that are more business-like, charging fees for services, trying to cover their own costs. Think like a city water utility. So it's government hospital. It uses governmental accounting principles.
Okay, government hospital, government rules. Makes sense. What else?
Two, it could be organized as a not-for-profit, a private nonprofit hospital. Tax exempt, but not directly run by the government.
Right, like many community hospitals.
Exactly.
Yeah.
These follow standards set by the FASB, the Financial Accounting Standards Board, completely different from governmental standards. They focus on things like unrestricted versus restricted net assets.
FASB, not GASB. Okay. And the third way?
Third, it could be a private for-profit business. A hospital runs specifically to earn a profit for its owners or shareholders.
Like some hospital chains.
Right. And guess what? It also follows FASB standards, just like the tech startup or the coffee shop we mentioned earlier. Heavy emphasis on net income, shareholder equity, the bottom line.
Wow. Okay, that is eye-opening. 3 hospitals, all treating patients, but potentially using 2 completely different sets of accounting rules. GASB for the government one, FASB for the nonprofit and for-profit ones. So for you, the listener, understanding the structure behind the hospital or the university or whatever service it is crucial. You can't just compare their financial reports directly if they're using different frameworks. It's like comparing apples and oranges.
You absolutely nailed it. It's a critical distinction, and it's why just looking at the service provided isn't enough. So building on that, let's lay out the kinds of organizations that typically do use governmental accounting principles because of their structure and funding.
Okay, let's start with the obvious ones, governmental units themselves. What all falls under that umbrella?
Right, that's the most straightforward category. It includes the whole spectrum of what we call general purpose governments. So the federal government, all 50 state governments, county governments, and then all the local municipalities, cities, towns, villages, townships.
Your local city hall, basically.
Yep. But it also includes a huge number of smaller, more specialized governmental units called special districts.
Special districts, like what?
These are set up to provide specific services in defined areas. Think about your local water authority, maybe a park and recreation district. The school district is often one, fire protection districts, sometimes even mosquito abatement districts or regional transit authorities.
Ah, okay. So single-purpose government bodies.
Exactly. They're legally separate governmental entities, often with their own power to tax or charge fees. And, importantly, this category also includes those government-run entities that might not scream government at first glance, like government-run hospitals we just discussed, or public universities if they are financially part of or accountable to a primary government. All of these use governmental accounting.
That really broadens the picture. What about colleges and universities specifically? You mentioned public ones might use governmental accounting, but there are tons of private ones too. How does that work?
Colleges and universities are a great example of this nuance. They might be governmental entities using GASB standards if they are financially accountable to a primary government.
Like a state university system being part of the state's finances.
Exactly. Or a community college district funded and overseen by the county. If the university's financials roll up into the state's or city's main financial report, it's almost certainly using governmental accounting rules, maybe as an enterprise fund, if it relies heavily on tuition and fees.
Okay. But what about the private ones?
Right. Many colleges and universities are non-governmental. They could be private, not-for-profits, think Ivy League schools, many liberal arts colleges.
Yeah.
Or, less commonly, some are actually for-profit businesses.
Okay.
In those cases, whether not for-profit or for-profit, they follow FASB standards, not GASB. So again, the big state university down the road might be using governmental rules, while the private college across town uses completely different FASB rules. Structure is everything.
And I'm guessing healthcare organizations follow a similar pattern. Hospitals, nursing homes, clinics.
They absolutely do. It's the same logic. These organizations, hospitals, nursing facilities, home health agencies, clinics can be governmental, not-for-profit, or commercial for-profit.
So how does a healthcare place end up using governmental rules?
It happens if the healthcare entity is financially accountable to a primary government. The term used is if it's a component unit of that government.
A component unit, what does that mean?
It essentially means that even if it's legally separate, the primary government is financially responsible for it, or can appoint its governing board, or get significant financial benefit, or bears significant financial burden from it. If it meets those criteria, it's considered part of the government for reporting purposes and uses governmental accounting principles.
Okay. But if it's just a standalone private nonprofit hospital or a for-profit clinic,
Then it follows the relevant FASB standards, just like the non-governmental universities or any other private business or NFP.
so it really hinges on that financial accountability link to a government. The source highlights a passkey on this. Seems like it's a really common point of confusion they wanted to emphasize.
It is, and it's worth repeating because it trips people up. The passkey essentially says, not-for-profit organizations, not run by governments like hospitals, universities, charities, research organizations, do not use governmental accounting and reporting principles.
That's crystal clear. A private charity running a food bank, even though it serves the public, isn't using governmental accounting just because it does good work.
Exactly.
Oh,
Its structure, its legal basis, its funding those dictate its accounting rules, which would be FASB nonprofit standards in that case, not GASB.
okay, that distinction is vital. So if these governmental principles are so unique, who actually sets them? Who are the architects making these specific rules?
That would be the Governmental Accounting Standards Board, or GASB.
GSB.
Okay. Think of GASB as the direct counterpart to FASB, the Financial Accounting Standards Board, which sets the rules for businesses and private nonprofits.
Mm.
GASB is a designated authority in the U.S. specifically tasked with establishing and improving accounting and financial reporting standards for state and local governments.
So they're the official rule makers for this whole governmental finance world.
That's right. Their whole mission is about ensuring consistency, comparability, and transparency across all these different government entities, which, as we've said, is absolutely essential for public accountability and good decision-making.
So GASB sets the governmental GAAP generally accepted accounting principles. Is there like a hierarchy to these rules, a specific order you're supposed to follow if you're looking for guidance? It seems like you'd need a clear roadmap.
Oh, absolutely. There's a very formal hierarchy laid out in GSB Statement Number 76. It gives accountants and auditors a clear, structured path to follow.
Okay, how does that hierarchy work?
At the very top, the most authoritative level is Category A. This includes the official GASB statements issued by the board itself. These are the big, comprehensive standards covering major topics: pensions, infrastructure, assets, how to recognize different revenues, things like that. They're the final word.
Category A, the main GSB statements. Got it. What's next?
Below that is Category B. This includes things like GASB technical bulletins, GASB implementation guides, which give more detailed how-to advice, and also literature from the AICPA, the American Institute of Certified Public Accounts. But only if that AICPA literature has been specifically reviewed and cleared by GASB.
Okay, so if Category A doesn't fully cover a specific situation.
Exactly. If a specific transaction or reporting issue isn't explicitly addressed in a Category A statement, you then look to Category B for more specific guidance or interpretation. They're like official clarifications or detailed instructions that support the main statements.
It sounds almost like a legal system. Category A is like the Constitution, the supreme law. Category B is like the statutes and regulations that provide the details. You start at the top and work your way down if needed.
That's a fantastic analogy. It really works that way. And this hierarchy is crucial for maintaining consistency across thousands of different governments. Without it, you'd have chaos, everyone interpreting things differently.
Makes sense.
And beyond just the specific standards in this hierarchy, GASB also operates under something called a conceptual framework.
Ah, the conceptual framework. That sounds more philosophical, like the underlying principles.
Exactly. It's laid out in GSSB concept statements, numbers 1 through 6. And you're right, they don't set specific accounting rules themselves. You won't find a rule for, say, how to depreciate a fire truck in the concept statements.
Okay, so what do they do?
Their purpose is to establish the fundamental objectives and concepts that underlie all of governmental financial reporting. They're the why behind the what's, the foundational principles that guide the GASB when they develop the actual standards in categories A and B.
And what's the main goal stated in that framework?
The overarching goal, according to the framework, is that governmental financial reporting should communicate essential financial information to users and, crucially, help the government fulfill its fundamental duty to be publicly accountable. It's all about making sure the information isn't just accurate, but actually useful, relevant, and serves that core purpose of demonstrating good stewardship. It's the North Star for everything GSB does.
Okay, GASB sets the rules, guided by this framework focused on accountability. Now let's get really practical. Who actually uses these detailed government reports, and what are they looking for when they crack them open? Because it sounds like these reports are a lot more than just a simple P&L statement from a company.
That's a great point. The scope is definitely broader. Financial statements are central, absolutely, but they're just one piece of the puzzle in governmental financial reporting. Users often need what the source calls all information used to assess accountability. That goes beyond just the basic statements.
Okay, so what does that broader package include?
Well, what we call general-purpose external financial reporting, the main package for outside users, includes the basic financial statements, plus the detailed notes that explain them, and also something called Required Supplementary Information, or RSI. This whole package often comes together in a big document called the Annual Comprehensive Financial Report, or ACFR.
ACFR. Okay, so a much bigger, more detailed report than typical business reporting.
Generally, yes. And it's also important to know what the framework's objectives don't fully cover.
Oh, like what?
Well, they might not fully address, say, the super detailed internal budgets governments use day to day, or certain special purpose reports like a report required by a specific grant agency that wants very particular compliance details. And it generally doesn't cover broader economic indicators or social statistics, though those are often used alongside the financial reports for context.
That helps define the boundaries. So who are the actual users? You mentioned users needing this info, but who specifically are we talking about?
The source identifies three primary groups who rely heavily on these governmental financial reports. Each has slightly different needs.
Okay, who's group number one?
First, and you could argue most importantly, are citizens. This is a really broad category, includes taxpayers like you, voters, people receiving government services, the media, researchers, community groups, basically anyone affected by the government's actions.
Oh, us, the public.
Exactly. For citizens, these reports are fundamentally about transparency. The right to know. Is my tax money being used wisely? Are services being delivered well? Is the government being a responsible steward? As a citizen, you're the primary stakeholder. These reports are your window into how your money is being managed.
Holding them accountable to us. Makes sense. Who is the second group?
Second group, Legislative and oversight bodies. Think state legislators, city council members, county commissioners, maybe a mayor or governor's office with oversight roles, state auditors, independent review boards.
The people elected or appointed to govern and oversee.
Right. They use these reports to make sure the government is actually operating the way it's supposed to. Is the executive branch spending money how the legislative branch authorized it? Are laws being followed? Are operations efficient? They need this info for policy decisions, budget setting, and exercising their oversight duties.
So for governance and control. And the third group.
The third group is investors and creditors. These are the people and institutions that lend money to governments or buy their bonds. Think big institutional investors, bond rating agencies like Moody's or S&P that give governments credit scores.
Okay.
Bond insurers, banks, other financial institutions, they're looking at the government's financial health and stability. Can this government reliably pay back its debts? Is its financial position sound long-term? Are there big risks? They need to assess creditworthiness before lending money.
So they're focused on financial risk and return. It's fascinating how these different groups look at the same reports but for very different reasons. How do they actually use them? What specific questions are they trying to answer?
They use them in four main ways, all crucial for making decisions, economic, social, political decisions, and of course, for assessing that core concept, accountability.
Okay, what's the first way?
First, comparing actual financial results to the legally adopted budget. This is huge for assessing fiscal discipline. Did they spend what they said they'd spend? Did they bring in the revenue they expected? It's a direct check on whether they stuck to the plan. Overspending, shortfalls, surpluses, this comparison flags it all.
Like a report card on their budgeting. Got it.
Second, assessing the overall financial condition and results of operations. This is looking at the big picture. What are the government's assets? What are its liabilities? Did its overall financial position get better or worse over the year? Is it financially healthy enough to cover its obligations, both short-term and long-term? It's like a checkup on its fiscal fitness.
Okay, overall health check, third use.
Third, determining compliance with finance-related laws, rules, and regulations. Governments operate under a ton of legal constraints. These reports, especially when audited, are key tools for verifying that they followed all those rules, spending money legally, ethically, for authorized purposes. It's proving they operated within the lines drawn by citizens and legislators.
Checking if they followed the rules. And the fourth.
Fourth, evaluating operating efficiency and effectiveness. Now, financial reports aren't the only source for this. You'd often look at performance data too, but they provide crucial cost information. How much did it cost to provide that service, trash collection, parks, police patrols? This helps users start to gauge if services are delivered efficiently, if they're getting good bang for the buck.
Okay, comparing results to budget, assessing overall health, checking compliance, and evaluating efficiency, that's a pretty comprehensive set of uses, and it all seems to circle back to what you called the cornerstone.
It really does. We cannot say it enough. Accountability is the cornerstone of governmental financial reporting. It's the fundamental reason these reports exist in the form they do.
It's the driving force.
Absolutely. Governments provide all this detailed financial info primarily to justify raising money from the public and to show exactly how that money was used for specific public purposes. Financial reporting is the main way they fulfill their duty to be accountable. And a key part of that, as GSB emphasizes, is showing they operated within the legal constraints imposed by citizens. It's like saying, here's the proof we did what you authorized us to do.
Makes perfect sense. Now, there's a related concept mentioned, sounds a bit technical. Interperiod equity.
Yeah.
What exactly is that and why is it important?
Interperiod equity. It sounds a bit academic, but the concept is actually pretty intuitive and really important for accountability. You can think of it simply as balancing the budget annually, or maybe more broadly, ensuring fairness between different generations of taxpayers.
Fairness between generations. How so?
It asks a fundamental question. Did the people who received government services this year pay for those services with this year's revenues? Or is the government pushing the cost onto future taxpayers by borrowing or delaying payments?
So it's about not kicking the can down the road, financially speaking. Making sure today's services are paid for by today's taxpayers, not tomorrow's.
Exactly. It's about fiscal responsibility over time. Balanced budgets are a big part of demonstrating interperiod equity because they show the government is trying to live within its means each year. Financial reporting should help users see if current revenues were actually enough to cover current services.
And if they weren't?
If they weren't, then future taxpayers will have to shoulder the burden, maybe through higher taxes later, or maybe reduced services in the future to pay for services enjoyed by people today. So, assessing interperiod equity is crucial for understanding the long-term fiscal health and sustainability of a government's policies. It shines a light on whether they're building up obligations for the future.
That really clarifies it. Fiscal fairness across time. Okay, so we know why governmental accounting exists, who uses it, who sets the rules, and these core principles like accountability and interperiod equity. What makes for good governmental financial reporting? How do we know the information is actually trustworthy and useful?
That's where we get into the key characteristics of good information in these reports. These are the qualities that make the information valuable for decision-making and accountability. There's a handy mnemonic to remember them: URMICE.
URMICE. Okay, that's memorable. Let's break it down. What's the U?
U stands for understandability. The information should be presented as clearly and simply as possible. It needs to make sense to people who aren't necessarily accounting experts, like an interested citizen, a reporter, a local official. Using plain language, avoiding unnecessary jargon that's key for public trust. Complex issues need clear explanations.
Okay, keep it clear. Avoid jargon. What about R?
R is for reliability. This means the information has to be verifiable. Different knowledgeable people looking at the same data should reach similar conclusions. It needs to be free from material bias, neutral, not slanted towards a particular outcome. And it needs to faithfully represent what actually happened. The numbers and descriptions should accurately reflect the financial reality.
Verifiable, neutral, accurate representation. Does reliable mean perfectly precise down to the last cent?
Not necessarily. That's a good point. Financial reports often involve estimates and judgments like how long a bridge will last or future pension costs. Reliability means the process for making those estimates is sound and applied consistently, not that every single number is absolutely exact.
Got it. Reliable process, not necessarily perfect precision. What's the M?
M stands for make a difference, which points to relevance. The information must actually matter. It should have a close, logical connection to the decisions users are making or the assessments they're performing. If a piece of information doesn't change a decision, offer new insight, or help evaluate stewardship, it's probably not relevant. It has to be impactful.
Has to matter for decisions. Okay. I.
I is for intimeliness or timeliness. The information needs to be available before decisions are made. Highly accurate data that arrives 6 months after the budget vote isn't very useful for that vote, is it? Sometimes getting reasonably accurate information out quickly is more important than waiting for perfect precision if it means informing a timely decision. It's about being actionable.
Right. Better good information now than perfect information too late. Makes sense. Seeing.
C is for consistency. Government should use the same accounting principles and methods from one year to the next. This allows for meaningful comparisons over time. If they kept changing how they recorded things, you wouldn't know if a change in their financial position was real or just due to switching accounting methods. Consistency allows trend analysis.
So apples to apples comparison year over year, and the final E.
E is for entity-to-entity comparability, or just comparability. Financial reports should be set up so you can compare the financial information of one government entity to another similar entity. If two cities are roughly the same size and offer similar services, you should be able to compare their spending on police, for example. Differences should reflect real underlying factors, not just different accounting choices. It allows for benchmarking.
Understandability, reliability, relevance, timeliness, consistency, comparability. URMICE. That's a great framework. But even with these qualities, governmental reports can't be perfect, right? There must be limitations.
Oh, absolutely. No financial report tells the whole story, especially for something as complex as a government. It's crucial users understand the inherent limitations.
What are some key ones?
Well, first, as we touched on with reliability, financial reports rely on approximate measures. Estimates, judgments about the future, they're necessary, but not exact science. Think about estimating landfill closure costs decades from now. It's an informed guess, but still an estimate.
Okay, so inherent estimation.
Second, these reports are just one source of information. They're much more powerful when combined with other data economic trends, demographic shifts, performance metrics like test scores or crime rates, citizen feedback. Financials tell you what was spent, not necessarily the impact it had.
Right, need context, part of a bigger picture.
Third, they may not meet the diverse needs of all users perfectly. A bond analyst wants different details than a citizen concerned about park maintenance. General purpose reports try to serve the main needs of the primary user groups, but they can't be tailored to every single specific question someone might have.
One size fits most, but not all.
And finally, a very practical limit: cost versus benefit. Gathering, auditing, and reporting financial information costs money, taxpayer money. The benefit of providing incredibly detailed or precise information has to outweigh the cost of producing it. Governments have to make practical choices about the level of detail versus the expense.
That's a sensible constraint. So, considering these qualities and limitations, what are the big overarching objectives that governmental reporting aims for? It sounds like it keeps coming back to accountability.
It really does. Accountability is the umbrella. The GISB framework boils it down to three main ways financial reporting assists users. First, it helps fulfill the duty of public accountability and lets users assess it. This means showing if current revenues covered current services, that interperiod equity idea, demonstrating compliance with budgets and laws, and providing info on service efforts, costs, and accomplishments, basically, were they responsible, legal, and effective.
Okay, accountable for money, rules, and results.
Second, it helps evaluate operating results for the year. Where did the money come from? How was it used? How did they finance activities? Did their overall financial position get better or worse? It's about understanding the financial performance during the period.
Got it. Financial flow and change.
And third, it helps assess the level of services the government can provide and its ability to meet future obligations. This involves showing the overall financial position, what they own, what they owe, information about long-term assets like infrastructure, and importantly, highlighting any restrictions on resources or potential risks. It's about future capacity and sustainability.
That's incredibly comprehensive. Really shows the breadth of information needed. So let's tie this all together. Our source emphasizes three major themes that truly make governmental accounting unique: fund structure, fund accounting, and external reporting. These feel like the core pillars supporting everything else.
They absolutely are the defining pillars. Understanding how these three work together is key to grasping why governmental accounting is what it is. They're distinct but interconnected.
Okay, before we get into the structure of funds, let's define the word fund itself very clearly. It sounds simple, but I bet it's super specific here. What exactly is a fund in this world?
It is absolutely critical, yes. A fund in governmental accounting is not just a pile of money. It's formally defined as a sum of money, or other resources could be investments, property that is specifically segregated for carrying on a specific activity or achieving certain objectives.
Segregated, kept separate.
Yes, and subject to specific regulations, restrictions, or limitations on its use. And here's the really crucial part. Each fund is considered an independent fiscal and accounting entity.
Independent entity.
Meaning it's treated like its own little financial world. And as we mentioned before, it's a self-balancing set of accounts. Each fund keeps its own books, tracking its own assets, liabilities, revenues, and expenditures, making sure debits equal credits within that fund. It's designed to ensure resources for specific purposes aren't mixed up and can be tracked independently. Totally different from a typical business with one main set of books.
That self-balancing aspect really makes the separation concrete. Okay, so how is this fund structure organized? GASB 34 seems to be the key standard here.
Yes, GASB 34 was revolutionary. It organizes the different types of funds. There are 11 official types into 3 broad, generic categories, each with a different purpose and accounting approach.
Okay, what are the 3 categories?
First, governmental funds. These are used for the basic day-to-day services most people think of: police, fire, parks, administration, road work, usually funded by taxes and general revenues. Their accounting focuses on the flow of financial resources. What money came in, what went out, did we meet the budget? Examples are the general fund, special revenue funds, capital projects funds.
Okay, basic government services, second category.
Second, proprietary funds. These act more like businesses run by the government. They provide goods or services mainly for a fee, intending to cover their costs through those fees. Think city water or electric utility, an airport, a public swimming pool, maybe a government parking garage. Their accounting is much closer to business accounting, focusing on net income, covering costs, long-term financial health. Examples are enterprise funds and internal service funds.
Business-like activities. Got it. And the third?
Third, fiduciary funds. Here, the government is acting as a trustee or agent holding money for others. The government doesn't own this money. The classic examples of pension fund for public employees, or maybe taxes collected by the county that it needs to pass on to the cities within it. The accounting focuses on demonstrating responsible custodianship of these assets. Examples include pension trust funds and agency funds.
Governmental, proprietary, fiduciary. Different categories for core services, business-like ops, and holding money for others. Makes sense. Do governments have to use all 11 types?
No, not at all. GASB allows flexibility. Governments establish only the minimum number of funds needed to meet legal requirements and manage finances properly. A small village might only need a few funds. A large state might need many more. It's about what's necessary for control and compliance.
Okay. Now, how does this fund structure connect to fund accounting in practice? You said different funds use different principles. This sounds like where it gets tricky.
You're right, this is a key differentiator and often a source of confusion. Even for accountants, sometimes the source notes is a frequent exam topic. The fund classification, governmental, proprietary, or fiduciary, directly dictates two fundamental accounting choices: the basis of accounting and the measurement focus.
Basis of accounting and measurement focus. Can you explain those?
Sure, the basis of accounting determines when you recognize revenues and expenditures or expenses. Governmental funds mostly use the modified accrual basis. This is unique. Revenues are recognized when they become measurable and available, meaning you know the amount and you expect to collect it soon enough to pay current bills. Expenditures are generally recognized when the liability is incurred.
Measurable and available. Okay. How is that different?
It's different from the full accrual basis, which is used by proprietary and fiduciary funds and all businesses. Full accrual recognizes revenue when it's earned and expenses when they're incurred, regardless of when the cash actually moves. Modified accrual is more focused on near-term cash flow and budgetary control.
Okay, so when you count, the money differs. What about the measurement focus?
The measurement focus determines what you're trying to measure. Governmental funds focus on the flow of financial resources. They track the inflows and outflows of current financial assets and liabilities available to spend. It's about short-term spendable resources and budget compliance. Proprietary and fiduciary funds, using full accrual, focus on the flow of economic resources. They measure all assets and liabilities, long-term included, and track revenues and expenses to determine net income or changes in net position, much like a business assessing its overall economic health and sustainability.
So governmental funds look at short-term cash and budget, while proprietary and fiduciary funds look at the bigger economic picture like a business. Why the difference? Why not just use full accrual for everything? Seems simpler.
It's a really fair question. It seems complex, but there's a strong reason. Applying different principles to different fund categories provides financial data that best aligns with each fund's specific accountability objective.
Ah, back to accountability.
Yep. Exactly. For governmental funds, the main goal is showing compliance with budgets and legal spending limits and managing tax dollars responsibly in the short term. Modified accrual and the financial resources focus are better suited for that specific type of accountability. It answers the question, did we follow the budget this year? For proprietary funds, the goal is often to show if the service is paying for itself, if it's financially sustainable like a business. Full accrual and the economic resources focus are better for that assessment. It answers, is this utility covering its costs?
So tailoring the accounting method to the specific accountability need of that fund type.
Precisely. It provides more relevant information for the primary purpose of each fund category, even though it adds complexity overall.
That makes the complexity understandable, even necessary. Okay, finally, all this structure in accounting leads to the external reporting requirements. What does GSB 34 say governments actually have to show the public?
GSB 34 requires governments to comply with GAAP to present both fund-based financial statements and government-wide financial statements.
Both. Okay, what's the difference again?
The fund-based statements provide that detailed view, broken down by fund category: governmental, proprietary, fiduciary. They use the specific accounting principles for each fund type: modified accrual for governmental, full accrual for others. This is where you see the details of each bucket and focus on compliance and short-term flows. The government-wide statements, however, present a consolidated overview of the government as a whole, excluding fiduciary funds, since that's money held for others. They use the full accrual basis and the economic resources measurement focus for all governmental and business-type activities. This gives a big picture view, similar to a corporate financial report, showing overall financial position and results of operations.
So you get the detailed compliance-focused view and the big picture economic health view. That sounds like the best of both worlds.
It aims to be. And of course, both sets of statements are accompanied by extensive notes to the financial statements, providing crucial details and explanations. There's also required supplementary information, RSI, which often includes things like management's discussion and analysis, MD&A management's narrative explanation, and detailed budget comparison schedules.
Okay.
And one final, really critical piece, reconciliation. Governments must provide a schedule that clearly reconciles the amounts reported in the fund-based statements, especially the governmental funds, with the amounts reported in the government-wide statements. This explains why the numbers are different, because of the different basis of accounting and measurement focus used. It helps users connect the dots between the two perspectives.
That reconciliation sounds vital for making sense of it all.
Wow. What a journey through governmental accounting. We've covered the why, public accountability, the who, not just governments, but depends on structure, the what GAASB rules and the URMIC qualities, the how users applying it, the core concepts like interperiod equity, and this unique fund structure that underpins it all. It's definitely complex, but incredibly important.
It really is. And the core takeaway, I think, is that governmental accounting is built from the ground up for public accountability, fiscal stewardship, and transparency. That's its DNA, in a way that commercial accounting, focused on profit, just isn't. The whole system reflects that unique public service mission.
Absolutely. And hopefully understanding these principles empowers you, the listener, the citizen, to engage more effectively, to ask better, more informed questions about how your local, state, or even federal government is managing the resources you've entrusted to them.
Right. So maybe a final thought to leave you with. The next time you see a government financial report, maybe your city's ACFR online, think about those URMICE characteristics. Does it feel understandable, reliable? What questions does it raise for you about interperiod equity or current services being paid for now? What will you look for to assess the transparency and fiscal health of your community? Thank you so much for joining us on this deep dive. We hope to explore more complex topics with you next time here on the Deep Dive.